Imagine the year 2008 when the world's largest economy came to a screeching halt because of houses. Yes, houses. Now, you might be thinking, how on earth can bricks and mortar shake the foundations of global finance? Well, my curious friend, it's a tale as twisty as a hedge fund manager's conscience. The 2008 housing crisis was a financial storm that left few corners of the globe untouched. So how did a bunch of houses cause such a global financial catastrophe? Let's dive in. To understand this, we need to travel back in time and look at the history of housing and financial crises. Our story begins in the early 20th century when the concept of mortgages was introduced. Mortgages, a type of loan where your house serves as collateral, were designed to make home ownership accessible for the average person. This meant that instead of having to save up to buy a house outright, people could now borrow money from banks and repay it over time. However, the ride was not always smooth, and the first major hiccup came during the Great Depression in the 1930s. A severe economic downturn led to high unemployment rates, and consequently, many borrowers were unable to repay their loans, causing a housing crisis. Banks play a significant role in housing finance. They lend money to home buyers and then often sell these loans to investment banks, who package them into securities and sell them to investors. This process, known as securitization, allows banks to free up money to lend to more home buyers, fueling the housing market. But what happens when things go wrong? The 1980s saw a wave of deregulation in the financial sector, leading to risky lending practices. This culminated in the savings and loan crisis, where hundreds of financial institutions failed due to bad real estate loans. Then came the Asian financial crisis in the late 90s, which started with a real estate bubble in Thailand and quickly spread across Asia, causing economic havoc. This crisis highlighted the interconnectedness of global financial markets and how a housing crisis in one country can ripple across the world. Fast forward to the early 2000s, a period of low interest rates and lax lending standards led to a housing boom in the United States. Everyone seemed to be buying houses and prices skyrocketed. This set the stage for the 2008 financial crisis, one of the most devastating in recent history. With this background, let's now focus on the events leading up to the 2008 crisis. The year is 2000 and the American housing market is booming. Picture this: home ownership is skyrocketing, and with it, the value of homes. It's a seller's market, but buyers are more than willing to pay top dollar. The dream of owning a home is within reach for many Americans, even those with less than stellar credit histories. Enter subprime mortgages. These high-risk loans offered to borrowers with poor credit became the golden goose of the housing market. Banks and other lending institutions, attracted by the prospect of high returns, started handing out these loans like candy at a parade. But it wasn't just the banks. Hedge fund companies, always on the lookout for profitable investments, also jumped on the bandwagon. With their deep pockets and appetite for risk, they poured billions into the subprime mortgage market, further inflating the housing bubble. These financial giants weren't acting in a vacuum, though. They were buoyed by a general belief that the housing market was bulletproof, that home prices would continue to rise indefinitely. It was a classic case of irrational exuberance with a dash of financial wizardry thrown in. To make these risky loans more palatable to investors, banks bundled them into complex financial products known as mortgage-backed securities. These securities were then sold to investors around the world, spreading the risk and the potential fallout far and wide. As the housing market continued to heat up, the warning signs were largely ignored. After all, the party was in full swing, and no one wanted to be the killjoy predicting a hangover. But beneath the surface, the foundations of the housing market were shaky at best. These subprime mortgages, the lifeblood of the boom, were essentially time bombs waiting to explode. As long as home prices rose, the borrowers could refinance or sell their homes to pay off the loans. But if prices fell, well, that was a different story. But as we all know, what goes up must come down. The stage was set for the 2008 financial crisis, a crisis that would send shockwaves around the world and change the face of the global economy. Fast forward to 2008, the bubble bursts and the world is in chaos. The collapse of the housing market was like a clap of thunder in clear skies, catching many unawares. But what really caused this lightning bolt of financial disaster? Our main culprits were the banks and hedge funds. The banks, filled to the brim with overconfidence, had been handing out mortgages like candy at Halloween. Irrespective of whether people could afford the repayments or not, the banks were more than willing to give out loans. Why? Because they thought the value of houses would keep rising forever. However, the reality check came in the form of a massive wave of defaults. Many homeowners found themselves unable to keep up with payments, leading to a surge in foreclosures. The banks, suddenly left holding the bag on these bad loans, faced significant losses. But the banks weren't the only ones with their hands in the cookie jar. Enter the hedge funds. These financial wizards were bundling these mortgages into complex financial products known as mortgage-backed securities. They sold these to investors globally, promising high returns. But when the defaults started, these securities turned toxic. Investors around the world faced massive losses, sparking a global financial crisis. The impact on the world economy was akin to a tsunami. Stock markets crashed worldwide, unemployment skyrocketed, and many businesses were forced to shut down. The ripple effects of the American housing market collapse were felt everywhere, from the skyscrapers of New York to the bustling markets of Tokyo and the quiet lanes of rural Europe. The world economy was like a ship in a storm, battered by waves from all sides. The housing market crash had triggered a domino effect, toppling banks and businesses and threatening to plunge the world into a deep recession. The world was on the brink of a financial meltdown, so what happened next? Well, that's a tale for our next scene. Stay tuned. In the face of disaster, the USA had to find a way out. Picture, if you will, a scene of financial ruin, the once robust pillars of the economy now teetering on the brink of collapse. But as the saying goes, it's always darkest before the dawn. So what was America's grand plan to claw its way back from the precipice? The answer, my friends, lies in a two-pronged approach of bailouts and regulatory changes. Firstly, the US government, as a knight in shining armor, swooped in with taxpayer dollars to rescue the struggling financial institutions. Now, this wasn't a case of misguided altruism or simple charity. Rather, it was a calculated move to prevent the complete implosion of the economy. A necessary evil, if you will. The bailouts, controversial as they were, provided a much-needed lifeline to banks and hedge funds. They served as a financial defibrillator, jolting the heart of the economy back into a steady rhythm. But the government knew that bailouts alone weren't enough. They needed to ensure that a crisis of this magnitude would never happen again. And so they turned to regulatory changes. The Dodd-Frank Wall Street Reform and Consumer Protection Act was born out of this necessity. This act brought about sweeping changes to financial regulation, placing strict oversight on banks and hedge funds. It aimed to mitigate risk and promote transparency, two factors sorely missing in the lead-up to the 2008 crisis. And so, with the combination of bailouts and regulatory changes, the USA began its slow ascent from the abyss. It was a painstaking process, fraught with uncertainty, but it was a necessary journey. And thus, the world slowly started to recover from the worst financial crisis since the Great Depression. The path was not easy, and the scars of the crisis still remain. But through resilience and reform, the USA managed to pull itself, and in turn, the global economy, out of the abyss. The story of the 2008 financial crisis serves as a stark reminder of the potential perils of unchecked greed and the importance of stringent regulation. But the scars of the 2008 crisis are still visible today. The global economy took a long, staggering walk to recovery, with some nations still limping. It was as if we'd all been on a roller coaster ride we didn't sign up for, and we're still feeling the vertigo. The housing bubble burst was not just an economic hiccup, it was a financial earthquake that shook the world. It was a stark reminder of our interconnectedness, for better or worse. When Uncle Sam sneezes, the world catches a cold. Banks and hedge funds, once the mighty titans of Wall Street, were brought to their knees, humbled and humiliated. They had played fast and loose with the world's money, and the world paid the price. But let's not forget the silver lining. The crisis was a catalyst for change. It sparked a global conversation about financial regulation, risk management, and corporate accountability. It forced us to re-evaluate our financial systems and institutions, to question the status quo. It was a wake-up call that echoed around the globe, a call we're still answering today. The 2008 crisis taught us that we're all in this together. It taught us that unchecked greed and unregulated markets can lead to disaster. It taught us that we must remain vigilant, that we must keep questioning, keep learning. The 2008 crisis was a harsh reminder that even the mightiest can fall, and a wake-up call for better financial regulation. After all, those who do not learn from history are doomed to repeat it. Until next time, keep questioning.